Hello, traders. It is Thursday, the 23rd of April, 2020. We're here today for another member study hall session. Today, we're going to be talking about zippers and rotations. This is something that's being asked about a lot, and we wanted to do a specific session for it. I do have um, this is going to be on the fly because the discussion about zippers and rotations really needs to be on the fly. I want to remind everyone that derivatives trading is not suitable for all investors. Past performance is not necessarily indicative of future results. With this particular topic, I would want you to ask questions as we go along. It's better than just coming back later to try to figure out what I was talking about a few minutes ago. Today, we're going to start out by defining what a zipper is and what a rotation is. Just to set a baseline, we're going to talk about zippers and what they tell us in real time, how we can use, how I use zippers for risk control. It's up to you. And then we'll switch over to rotations. We're going to talk about how we measure rotations and rotational probabilities just from a statistical point of view, and then sizing positions and risk based on rotations. So these are two different topics. Zippers and rotations are not the same thing. But we compress these together mainly because of demand and because they're somewhat related. So defining a zipper. A zipper is simply a consolidation. Let me pull my charts up here. The best way to see a zipper is in a short-term chart. In fact, I wanted to switch back to 4-tick Renkos so we can see it a little bit better. It'll take a minute to recalculate. So zippers are little consolidations. It's a kind of a brief moment of rest, a brief moment actually of uncertainty by market participants. And what it does is it creates this tiny micro balance. Zippers can be seen. You can define a zipper on a 1-tick chart all the way to a weekly chart. They're not confined to any, just like everything else, they're not confined to any particular time frame. I don't really confine anything to a particular time frame. So, in general, zippers just look like these little areas where the market's just chopping back and forth. That's a zipper. That's a zipper. And the reason it's called a zipper, or I called it a zipper a long time ago, is because it's made up of bars that look like this. A lot of times they just look like that, and they look like, of course, I'm a horrible artist with a mouse, and it just looks like just a regular zipper. We see it on the chart, and it's just a bunch of bars that are just lined up closely together, and it shows that the market's up ticking, down ticking, up ticking, down ticking, but it's not really going anywhere. And that's what a zipper is. A rotation is something that is more loosely defined because it's time frame dependent as well, but also it depends on what kind of parameters we place around what a rotation is. For example, the way this chart is set up, it's basically saying that as long as price doesn't respond back or does not revert back, or there isn't a counter rotation of 19 ticks or better, as it's set here, then it continues to consider the move as one rotation. So this move here from 28.16 down to 27.92.50 is a 23.5 point rotation, as this box says right here. It's 23.5 point rotation. We consider that one rotation. We could see it plotted on this piece of software, and of course everybody's using something different. It's plotted in this lower pane, and it's keeping track of what the rotations are. The counter rotation is 6.25 points, and you can see it plotted right here. And the reason I decided to plot these down here separately as opposed to just reading the numbers, is because it gives me a graphical view of how the rotations are doing. So rotations are just the back and forth of the market. Zippers are made up of tiny little rotations that are consolidating, and zippers are just balance zones. Rotations just describe something more general, which is just the behavior of the market when it swings back and forth, and that's where that stands. The next thing I wanted to discuss here is zippers and what they tell us in real time. What a zipper tells us in general in real time is that the market has made a move. So I'm going to use the real-time conditions here. Let me expand my chart a little bit. Let's go to 60. And what often happens with zippers is they give us two things. One is they give us an opportunity to see the move getting exhausted. You see that little set of bars there? There are 4 bars in the zipper right here, that little zipper. It's basically an area where the market has been confronted with the opposing force at 28.14. So let's see what that looks like. Here's what it looks like on a footprint. It's really hard using this tool. I wish there were some keyboard shortcuts. So 28.14. So this is that zipper consolidation. Remember, we did a webinar on a study hall on the footprint. You might want to cross-reference that. But as the market moved up, it ended up consolidating and building, although it's thin right now because of this Gilead news, but it ended up building a little bit of a consolidation area before it pulled back to here and then opened the next bar. It downticked, and so the next bar was opened down here. And what formed the top of this bar is a zipper. And characteristic of a zipper, just to talk footprint for a second, characteristic of a zipper is a bar that has numbers on both sides very, very often. Right here, 285 and 12. In general, we see bars having a 0 versus what's on the offer at 13, or 0 on the offer and something on the bid. As the market hits the bid, it records 6. So that one side should always be 0 if it's a normal bar, an excess. When you have a bar that has numbers at the top, it generally looks like a zipper on the trigger chart. That's the kind of relationship in between. So back to this. So here we are. We have a little zipper, and what that zipper is telling us is, hey, we're starting to confront the opposing force here. We're starting to confront resistance if we're running up. We're starting to confront support on the way down, and it gives us a chance a lot of times to, if we are up against a key reference, it gives us a chance to enter at a favorable price and look for the rotation down. Oftentimes, zippers are what make up flags. If you recall, just as a review, a flag is an impulse or a move that consolidates like this and then resolves itself in the direction of the original move, right? Flags can be positive or negative. So this is a bear flag here. The initial move is this way. And we're always, whenever we see this impulse, we're always looking for the zipper area as an advantageous entry point to enter for the continuation. We're always looking for the continuation. It's hard to catch the initial move a lot of times. And so where this ties in is it ties into rotations in that, zippers are much easier to see once we have an impulse. An impulse is defined as a 90 percentile move rotation over a period of time on set parameters, and I'll show you what that looks like. And so that's what that is. The bottom line is, zippers give us an idea of where things are kind of stalling and where things are resting. So it could be a bunch of bars at the top or bottom. It could be like this W formation or an M formation. These are all zippers here. The market kind of rests or balances in a zipper. And if you look at a much higher time frame, say 15-minute or an hourly or something, and zoom out, you'll see zippers on the 15-minute bar chart. You'll see zippers on a 60-minute bar chart. You'll see zippers on a daily bar chart. They are independent of fractals because the market tends to move, digest, move, digest, move back, digest, move back, digest, move up, digest, move down, digest. The digestion part is the zipper part. And what it shows us is rotations that expand like this one, and it shows us rotations that are consolidating like these. Okay, so that's the gist of what we're covering today.
Before we move on, a couple of questions.
Sure.
Uh, are zippers better defined on a Renko chart, and do you suggest that it's advisable to use a Renko chart to see the zippers?
You can use whatever you're comfortable with. I know that's not the answer that people want because everybody's trying to figure things out and they would rather have have a definitive answer, and I don't have that. But here's the thing with time versus tick or volume-based charts. Time-based charts keep ticking along even when things aren't happening. So if I look at a 1 minute, I'm switching to a 1 minute here, which is about what a 4-tick Renko is. If we do a 1 minute, if the market is dead, which we don't have an example of that recently, a little bit yesterday maybe. So you have these rotations on a 1 minute, and then there are times when the market doesn't really accomplish anything, but you still get a bar, you still get an additional bar because time ran out. And I'm not interested in time. Like, a question that I have to ask you is, like, for example, see this move right here from 28.27 to the low, 27.86. It's 2 bars, 3 bars. It's 3 1-minute bars. But there's a lot of information in there. Now let's pay attention to this move from 28.27 down to the low on a 4-tick Renko. More information is not necessarily a good thing, right? 28.27, so somewhere in here, right here, you don't see this consolidation here. You don't see this action in here, this 16 quarter, 16 test, break, and so on. You don't get to see that in a 1 minute bar chart because all it cares about is time. But you have to ask yourself, do you care about time intraday? Time matters when to me, and this is always my opinion when I'm discussing these things. It's not right or wrong. There is no right or wrong here. It's just my opinion based on my experience. Time matters when we open. Time matters when we have scheduled releases, conferences, things we know about. Time matters when the IB is done, and time matters when we close. That's the only those are the only times that time matters to me. But intraday, what do I care? What do I care that it's 8:58 a.m. versus 10:42 a.m. And that doesn't inform my decisions. What informs my decisions is movement, because you and I make money out of movement, period. If the market sits and ticks at the same price for the next 2 years, we're all going to go broke. I'm not going to be able to make money because it's the same price. And so all I care about is movement. So I tend to gravitate towards range-based bars. So I've used PNF bars, point and figure bars. Those are range based. The X's and O's are based on range. I've used volume bars, 144 tick versus a 386 tick versus all these Fibonacci based volume bars. I've used range bars like a 4-tick range bar. I've used Renkos, and I've stuck with Renkos with wicks. These are not normal Renkos because I add the wick on there. And the reason I add the wick on there is because I want to see the Renko bar, but I also want to see where the high is. So if I put this fractal indicator with a standard Renko bar, it'll seem like it's giving me a number, but it never traded there because it's missing the wick. So it's not a standard use of a Renko brick bar type of thing, but these are essentially range bars. And I don't want to print bars just because time has passed. It's a passage of time. I'm not measuring the passage of time, I'm measuring rotations. Okay, so it's easier, I find, to see where the consolidations are. If the market slows down enough, many of you recall, we used to use a two-tick Renko, like since we launched Convergent 2 years ago. Much of the chart definitions had two-tick Renkos, but the two-tick Renko, look at how noisy that is. It's too much because there's a lot of range and there's just a lot of information here. I don't want that. So what you may be picking up here, what I'm hoping you're picking up here is nothing's fixed. Everything's adaptable. And the question is, what do you want to see? How much do you want to see? Like drawing a microcomposite profile. Well, where should it start? Where should it end? I don't know. What do you want to see? What do you want it to include? What's important to you? That's where that comes from. Do you
I'm
have
going to
anything?
hold the rest of the questions to the end because otherwise you're not going to finish the presentation.
There's not much more. Um,
Okay.
so so the zippers. So the next question we're looking for is what zippers tell us is the market in consolidation in a microstructure, meaning we're looking at the day time frame, which is considered a very small structure for somebody who's swinging or for an investor. But there's also a microstructure, and a microstructure, a zipper in a microstructure tells us, gives us a sort of a measure of where the consolidation that has occurred after compression, after the impulse, how that consolidation is resolving itself, right? So what we have, I'll give you an example of what I see right now. If I needed to get short, for example, I would be watching it pushing into a key area defined. So here's the top and bottom of this zipper microstructure, and we see that 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 it pushed up, consolidated, and I would expect another push up, let's say, and I can see that hey, this microstructure is failing once it takes out the 2811, and that zipper gives me an idea that hey, things are changing. So how is that practically used? Here's the market bouncing up, so we get a a an impulse. So this is one. We have an impulse. Let's say I'm looking for a long from yesterday's close, which is right here, this orange line. I'm looking for a long. Then we get this impulse. I'm not going to be on that impulse. If I was trying to sell you on a signal or whatever, I'll tell you that I've caught every impulse on the chart. That would not be true. I cannot trade this impulse. It's not there. So now I'm stalking to see if this particular zipper structure right here breaks to the upside because I'm looking to get long on the impulse because my idea was to get long down here, but I missed all of that. So now I'm going to tell myself, look, I'm going to lean against yesterday's high. I'm going to lean against the overnight high. I'm going to lean against the open to look long, and I'm looking to trade the long to bring us back because this is a news-based event, and we might get back and visit the SOC of the news event. By the way, this chart's moving, so my drawing is going to shift. But it decides to break down. Okay, well, that's not a good sign. So out of this zipper, this would be my risk control or measurements zipper to tell me what the market really wants. What I would want to see, I would want to see it kind of break higher, pull back, higher low, and then I'm looking to get in and push for that high at 14. That's the setup for this. Let me erase this because it's shifting out of range. But instead, it pokes through the 2807. So now I'm using the bottom of the zipper, 2803, these three lows all at the same. I'm using that to see, okay, do I get a higher low here? In which case I would lift the market and I would look for 2808 to be gone. And I would look for 14 as the first scale out. Then I would start working other areas, 2822 ahead of the IB, blah, 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 blah. okay, for a simple long trade reversion to the news SOC. But what it did is it broke down. And so now I'm like, okay, this doesn't look very healthy, but it still held yesterday's close. So the question now becomes, okay, does it come down to the yesterday's close ahead of it and form a zipper and break to the other side, or does it impulse around, or what does it do? Oh, we put in a higher low, and now we're moving higher. We've moved higher than where we were here. Now I'm going to look for a zipper. I'm going to look for a zipper and scalp the long, and that scalp would have looked for a break of the zipper high, boom, a higher low, boom, get long anywhere in here, and then start working for 14 and a quarter. And so you sit through this, and that's how I'm using zippers to understand what the market wants in real time on a short time frame. Okay, that's why it's important. I'm not waiting for a moving average to turn. I'm not waiting for an RSI to look back 14 or 21 bars or minutes to tell me. I'm seeing it in real time, and it takes a lot of practice to be able to read it in real time. And what I'm looking for here is that becomes my control structure. This structure right here becomes my control structure. So initially, the scalp long is looking for a 4-point stop somewhere, trigger around 2802. Anything below 98 is likely to stop me out. I'm probably wrong, and it's probably going to come back and take out this 92 and continue lower. And then as the market pushes up and creates more zippers, as it breaks higher, I'm looking at these zippers as a way of measuring the health of the trend that I'm a part of. So here at 14 quarter goes to 1450. I don't want it to breach. My stop cannot move yet, but I don't want it to breach this zipper here. I don't want it to break below the zipper here. What does it do? It comes back to the center, the point of control, really. If I drew a profile around the zipper, and bounces off of it. Okay, I'm still in good health here. Still need to hold on. And now I'm managing, now that we've tested the zipper and moved, now my stop moves up here. I'm under this microstructure, this zipper, and the more recent zipper. Notice I'm not moving my stop from here to here as soon as it breaks. I'm really waiting for it to move up, test, move away from that zipper for that to become an area that I'm interested in. And now, so I've got my stop up here at 2805 or so, and that would have been pegged right here because now we have an impulse down. See how it's breaking the red line, the impulse line? Something is changing here. Now, and let's look at real time, zippers in real time. Zippers in real time are telling us we've got an impulse. So now I've got the mid at 2807. That's this dashed line right here. And I'm looking at this microstructure as it's forming. So now we've got a zipper forming right here. And I want to see, how does the market move out of the zipper? If it moves out of the zipper on the buy side, remember, I'm looking at an impulse down, then the next measuring piece is the mid of this consolidation, of this impulse. So I'm paying attention if it breaks higher. If not, if it breaks lower, then it becomes, because of the risk being so far out, it becomes a scalp short. And if I'm scalping short, I'm looking for 92s here next. And if it breaks the 92s, then I'm looking for the low and a further extension, on and on and on. And as it moves around, let's just form our own chart. Okay, let's just create our own chart here of what may happen. So it consolidated, pulled back, formed this tiny little zipper right here, this little box, and let's assume we're just really aggressive and we took a short in here, and now we're in the money. Now I'm looking for it to move down to the next consolidation area, down right here between 95 and 92, expecting it to chop around. And now it's going to form another zipper and it moves down. I'm still going to keep my stop up here, but as soon as it pulls back and then comes back again and forms an additional zipper and is not able to take out the last, then I'm controlling risk by using this zipper, because this would be the structure. This would be the structure that the market shouldn't, using that word softly or lightly, because the market does what it does, shouldn't easily take out the last zipper that it just tested. Like it shouldn't come back up and take out the zipper and I'm still trading this impulse down. It shouldn't be able to do that, or I don't want it to, I should say. So instead, I wanted to pull back. I pull my risk down here. I'm trailing my risk above this zipper. I'm looking for the zipper to be protection. And if it continues and moves lower, then I'm going to look at the next zipper. Didn't form one here. So now I'm waiting for another zipper to form or for this zipper to be tested. For example, come back, continue. Now my stop moves here. It's a tested zipper. I don't expect the market to come back up here and so on and so forth. And that's how we use zippers for risk control. That's the third bullet here. Okay, oops, let's clean this up. So that's this topic right here. Any questions on zippers? Because I'm moving on to rotations now.
Zippers, okay. We got a question on zigzag, tick size question, tick size, lots of questions on setting tick size. No, nothing on zippers.
Okay, yeah, the tick size question I already answered with the example of a 1 minute versus four tick Renko versus time bars versus.
I think a lot of people don't understand how you come up with that, but I think what you really said, if I can paraphrase, is it's just what you're looking to see. So if you put a 1 tick on it's too fast, not too many zippers, you increase it until you like what you see. It's
exactly
sort of like cooking.
Exactly. Cooking is a great analogy. You might get a recipe that says add 2 teaspoons of salt. You add 2 teaspoons of salt and you make the dish, you set it, you're proud, people start tasting it and everybody's reaching for the salt. That salt was good for the person creating the recipe and whatever ingredients and brands they use, it's not good for you, so you just adjust it by adding a little more salt. It's kind of like that. How much do I want to see? How much do I want to see on a chart? I don't want to see every tick. I don't want to see a bunch of a string of little Renko bars everywhere. I don't want to see that. In general, unless there's a move in general in the ES, a 2-tick Renko under normal conditions, which we're not in, is about a 1 minute bar, but it doesn't form until there's movement. Okay, and it can range from like 1 to 4 minutes for each Renko bar to be formed, depending on how slow things are. If you have an impulse, notice the time here at the top of the screen, the top of the thing right up here. Notice the time. This impulse here started at 16:51, 18, and then it went to 18:05. This is all Chicago time. 18:05. 1927, 1940. So it went from a 2 minute bar at the top to about a 40, 50-second bar. The next bars are about 40 or so seconds each, 30 seconds and so on until things slow down. And then it becomes slower still. And all I'm seeing is the movement of the bars, not time, because again, I'm not interested in time. Okay. So here in this example that I was just talking about, we had that little continuation. We formed the zipper. You see how that zipper is formed, and we started to take that zipper out. That's a warning. This is where I usually put out, hey, warning. And then it needs to hold this 2802, 2800 area, and it's not. And that pretty much ends this impulse down move scalp, so to speak. Anyway, since we don't have any more.
While we're on that though, on that chart,
Okay.
and it's dealing with zippers, it's just occurred on this zipper and it's occurred on a couple of them. And someone said it seems a lot of the zippers break a few ticks and then return across the whole zipper before ultimately breaking significantly. Is that something that you find or
It
can comment
doesn't.
on?
Okay, so I don't have an example of this, but here's.
Yeah, you do. Right at 1227 is where it happened.
1227.
Right there. Go above. Go up. You
Right
see how
here.
the zipper formed? It pushed up and then pushed down and then went up right through the zipper again.
Right. This is kind of a actually this is a bit of a typical reversal pattern. Here's the thing. I don't sit here and look for a zipper to form and then I catch the breakout to the downside. The reason is there's a lot of there you get a lot of false breakouts. I'll give you an example. You have a market that drops, you have a zipper consolidation that forms, and then you have a break to the top side a lot of times. You have a break to the top side, and then what it does is it comes back, consolidates, and then goes the other way. This is a failed attempt to push higher, which gives these people a much higher confidence of getting short. And so what I look for is if I'm trading to the downside, the pattern I'm looking for is drop, consolidate. It can break the other way, whatever. I don't really care because I'm looking at the impulse. I'm still looking short. There's no reason for me to look long. It's a kind of a flip trader scalp to try to get the long. What I'm looking for is not that it breaks the low of this zipper. Like I'm not looking to trade the breakout. What I'm looking for is for it to take the breakout, come back and form a weak retest. That's the pattern that Tendex and I talked about, I don't know, 3 weeks ago or something in one of our webinars. I'm looking for the retest to be weak because a lot of times what the market does is it drops, consolidates, breaks lower, and then it just rips the other way. It's found its buyers. What I want to see is I want it to work hard to be able to take me out. So I'm looking for a zipper that breaks lower and then retests. I want to see that retest. And that's the thing, like, don't be so afraid. What the heck? Don't be so afraid of missing the move. It's okay. Wouldn't you rather miss the move than to be in a lot of moves that cost money, right? And so I'm looking for a false breakout. So let's we don't have the time to watch this unfold, but here now we have this impulse that we have an impulse, pullback, continuation, and now this is what's potentially the corrective move, right? This is what I would expect. If I'm looking for a long, I'm going to wait for this to consolidate like it does. Look for a false break one way or the other. I'm going to look for a retest and then get long. Not, hey, it's gotten long. Let me set a stop buy limit above the zipper and take that trade. I think that's a low probability trade. What I want to see is it breaks and it's incapable of going the other way, and therefore I join. And it's not because I'm looking for confirmation, it's that I want to see that the market's just incapable of moving in the opposite direction. So I'm not involved in the stop run attempts, the noise, so to speak, of what it's doing. But I want to warn you that all of this is based on a main idea. And in this case, the main idea is we've had a move down, we've had an impulse down, we attempted to push higher and it just could not hold. So I'm going to look to the short side. The trend of this move is short. And so now my job is to just find an entry point. I can find that entry point in a zipper. I can find it in the footprint. I can find it in many different places. That's not the issue. The issue is, hey, figure out your bias first so that when you do get in a trade, you're holding firm and not jumping into a trade for 2 ticks with a 4-point stop on a repeating basis. I think that's important to recognize that I'm not looking for zippers that break or the zipper retest pattern. I'm not looking for that all the time. By the way, this is the worst kind of zipper here. This is deadly. This is the kind of zipper where you got short and it keeps moving up, but it's not really pushing violently and it just pulls back just enough, just above your entry short. You know, it's just 1 tick higher and it pulls higher and it looks like it's done and it comes back and it puts in a higher low and just a terrible kind of, this is like an ascending zipper here. It basically tells us that somebody's slowly accumulating accumulating and buying this thing back up. So we're likely to see that 17.5 top once again. Anyway, let's move
Last
to rotations.
last question, if you can be quick. You said you enter once it has a weak retest. Someone doesn't understand what you mean by a weak retest. If that's a quick one, or we can do it at the end.
Here's an example of a weak retest that I used a little bit earlier. Let's say I'm trading, hypothetically, I'm trading this impulse up. Clear? We're looking for a long. So we got this impulse. We're not part of the impulse. Then we form the zipper right here. You see that zipper? It's this consolidation chain of bars that just consolidate. Then it breaks higher. I'm not buying this break. What I am looking for is this. That's the weak retest. It comes back into the zipper, to the top of the zipper. It has a pullback, but it just doesn't have the sellers in it. And the sellers are failing to push lower. That's what I want. That's when I'm looking to get long. So now I'm looking to capture as fast as I can. I'm looking to capture and get long whatever on the basis that I'm trading in this direction, no matter what, and I'm looking for a failed retest by sellers. So the best opportunity I have is that the opposing force is weak. In this case, sellers. If the sellers are weak, I have a much better opportunity for my long because I can see that here it broke higher, had a chance to pull back. Now it didn't fall through, in which case I'm not long, and unfortunately that trade is gone. But it tried to push back in. It put in that higher low in the zipper. Remember, the zipper's right here, and then it continued. This is a very simple price action based entry pattern. Okay, very simple stuff. Let's talk rotation so we can wrap things up here. So the next thing we want to discuss is rotations. People get so confused by this. It's very, very simple. Rotations are the market's kind of pulse. It's ebbing and flowing and ebbing and flowing all the time. And the way it flows, here's a 1 minute bar chart. The way it flows, I'm looking at kind of consolidating or understanding how it statistically flows. And so this is important here. This chart's important to me. If under normal circumstances, the parameters for this chart are set to 20 days, the bin size, this is for those of you who know statistics, a statistical bin is how do you want to organize the information? For example, I know there are many Europeans here, but let's use American shoe sizes. Okay, so we're not talking about 44 male versus 38 female or whatever. Let's just say the shoe sizes are 8, 8.5, 9, 9.5, 10, 10.5, like those kinds of sizes. The bin size is if I had a huge range, let's say I'm looking at shoe sizes from baby size to full adult, there would be a huge range. And if I don't want to display that huge range, and I don't want to break up the shoe sizes by half sizes, I can say bin the information into full sizes. So the bin would be 1. Right? But if I want to see every single size represented, then I put down the smallest tick. The smallest tick in the ES is 0.25 of a point, and that's what I choose to put in there. Right? But if I set this to every 1 point, the data changes. See how much smoother it is? Right? Even if we recalculate, you see this bar is smoother, and it's going every point. It's showing us every point. And so whether it's 6.25 point rotation or 6-point rotation, that falls under the 6-point piece, right? So I put the bin at the smallest tick unless things are a little bit crazy, and so I consolidate. So now you see how much more granular this is. And then I set 20 days, a whole month. I'm looking back a whole month. I set the periodicity. Generally, it's 1 minute because the reason we use 1 minute is because my data feed stores 20 years of 1 minute bars. But in order to go beyond a certain number of days on anything below a minute, it has to rely on tick data. And if you're using tick data, that's a lot of information for it to recompute a 2-tick Renko or a volume bar or whatever. So we go to a 1 minute because we're not landing a rocket ship on a moving asteroid or anything fancy like that. We just go with 1. This sets the session. This is set to my time here in Chicago, 8:30 to 3:15. That's the pit session. And then fractal bars, essentially what this sets is, hey, define the top and the bottom of a swing. What are the top and the bottom of a swing? And what I'm telling it here is every time a bar is printed, and it's the highest bar of any bar, of the 2 bars after it and the 2 bars before it. So it's a 5-bar fractal. If it's the highest bar, then that's the top of my swing. I can set it to 9. I can set it to 7. It needs to be odd because you can't have an even number for a fractal top or bottom because you have to have a bar that's higher than the ones that follow to the right and the ones that precede it to the left. And so I set it to 5. I could set it on some volatile stuff. I'll set it to 9 or 7 to reduce the number of rotations. So that's the fractal. And I say recalculate. And it goes in there and it basically starts out and says, okay, this rotation had 22.25 points. It plots that rotation down here on this graph. It's measuring, in this case, it's fancy. It's separating the up rotations from the down rotations. And it's doing that going back 20 days. And so what it's looked at is it's saying, look, given the parameters you gave us, down here, let me draw this. Down here, what it's saying in this chart is that we found 742 up rotations, given the parameters you've set, and we found 742 down rotations. They're usually not the same amount, but it is what it is. And then it gives us, it plots what is a value area profile. This is just a histogram because in real life, data doesn't present itself in a way, where it's so beautiful. You know, it's just got a nice tail and middle and a nice tail. Generally, data in real life skews left, skews right. It has a fat tail, left or right. You know, it looks a lot like this, which means it's skewed left, or like that. It's not generally in the middle. So coming in here and using an average, this is why we use averages. Using an average can describe this data. Using an average of the data puts you here. It doesn't describe the peak. That would be the mode. It doesn't describe the fact that figuring out the standard deviation of something that's uneven, so this would be the first standard deviation, the first sigma, of something that's uneven doesn't really tell you anything. It doesn't. So we want to, I use this profile, I use the software which has built into it this profiling capability to describe what the real life data is. And that's what we get in this graph right here. It's taking all of the data to the left, all of the plots to the left, and it's generating a summary. And what the summary is saying is this: for up rotations in the ES, right? This is the product ES on a 1 minute chart, looking back 19 sessions, 1 minute periodicity with a 5-bar fractal. Here's what you've got. You've got 742 swings, which means we have a big enough sample. Your mode, or your most common, is 8 points. This used to be 2.5 for the S&P for years, okay? 2.5. What is normal? That's the value area at 68%. That's the first sigma that represents 68% from the mode, right and left. It's telling us that what is normal is anywhere between 3 for rotation up. What's normal is somewhere between 3 and 11.5. And then I use a 90 percentile, which is a 1.66 sigma, to describe an impulse. And all I'm saying here is, look, about 70% of the time, it's trading up to 11.5 points. 11.5 points. Okay, that's what's kind of normal for this product. What's abnormal is 17.5 points. That's an impulse. So I'm in rotations, the definition of an impulse for me, and you can go and use a second standard deviation, which is 95.45%, or whatever. This is just basic statistics. You can use that. I found that to be too much. So I went with 90%. I read some studies on it. I decided 90% would describe an impulse, and then I went back and tested that idea. Okay, when an impulse happens, how often does an impulse result in a continuation trade? And it results in a continuation trade more than 50% of the time. So that could be something that I can build an edge around, and that's why I keep talking about impulses and continuations. So this number, this 17.5, gets actually put on my trigger chart as the red line on the rotational pane at the bottom of my trigger chart, okay? And then it's saying that the maximum rotation, given the parameters, in the last 20 sessions is 50.75. Now here's what this means. This means that if a move goes 11.5 points, okay? So if a move of 11.5 points occurs, as it's pushing towards 11.5 points, we consider this normal. It is now falling outside of normal for it to continue pushing farther. And if it gets to 17.5, there's less than a 10% probability, historical probability, that it's likely to continue beyond 17.5 by much. Okay, and so as we look at rotations, if I switch this to just for demonstration purposes here, if I switch this profile to a second standard deviation instead, so 95.45%. Okay, what this is saying is if you're involved in a move that goes about 22 points, if there's a move that's 22 points, there is less than somewhere around 4% or so probability that it's likely to stretch even further without pulling back, without creating a new rotation. So as we move into a stock zone or a level that's predefined, and we have an impulse of 17.5 points, and then we have a pullback so that the rotation recalculates, chances of us having two impulses in a row are pretty low. So as the market moves into the stock zone now, I'm much more confident about fading that move and selling it because it's already stretching. So this is just playing on pure statistics. Now, I think I probably opened a can of worms here because I'm not taking the time to explain it fully, but rotations simply tell us what is normal, what is not, given the parameters that we've entered here. Recently, because the market's been changing so dramatically, so fast, I've been using 10 sessions, okay? If we switch to 10 sessions, we find out that, let me switch this back to what's normal. If we look at 10 sessions instead of 20, remember 20 involved some really big limit up, limit down days and so on. If we just go 10, it's a lot more recent information, but in return, you're giving up the sample size. So you see the sample size is now much lower. So our confidence interval statistically is lower. It's only 330 versus whatever it was, 720 or whatever it was. But it tells us, hey, normal is now 9 points, up to 9 points on the up rotation, and normal is, and an impulse is 13.5 points instead of 17.5 points. So now we're watching out to see, okay, we have a 13.5 plus move. We're looking for a consolidation. We're looking for continuation. In either case, This is what this chart here, and I used to do this for those of you who recall. I used to do this by hand. I've done many, many spreadsheets with members. A lot of the members here have known me for the last 10 years. I've done this by hand, and then I believe it was Hampton, a member of ours, created this chart that solves the problem through a definition. And this can be done in many different platforms if you know how to code it. But that's what these rotations are. Now let's translate that into something that's useful, because we can all talk theory until we're blue in the face. This is where this red line comes from. These red lines just tell me where an impulse is. And I want to move towards the 20-day, back to the 20-day. So I've left them here at 16.5 up, 16.5 down. They should actually be about 17.5. And I'm looking for, I'm monitoring for what falls within, and I used to have a second set of lines to tell me what is normal, but now I just monitor what an impulse is. And I'm constantly watching rotations to help me understand what is normal and what's not. So final part, since we're over time here by a lot, sizing things. How do you adjust for volatility? Rotational studies are my go-to to tell me how far I need to have my targets from my stops. So if I'm using this information, the last 10 sessions and blah, 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 and what is normal is 9 points, it tells me that, hey, if I decide to go in here and have a 2-point stop, I am below value low of any given rotation. See, the value low here is 2.5 points. So what's normal is somewhere between 2.5 points and 9 points. If I use a 2-point stop, I'm essentially saying that is way inside of what is normal for this product. Okay, and so if the market's rotating according to this thing, whatever the pattern is that it's doing, okay, here's a balancing market. If it's rotating +9, -6.5, +9 maybe again, -5, and I come in here and I get long with a 2-point stop when it normally rotates anywhere between 2.5 and 9 points, the probability is really small, 2-3%, that the market will pay me with that small stop. I need a large stop. Oh, my headset's about to die. I need a large stop. I need to account for the fact that I should have my stop somewhere in the 9-point range, and I should have my target somewhere in the 6.5-point range. That's what this chart is saying. Okay, and so that's how I'm sizing my stops versus, shoot, my headset's about to die. I'm using the heck out of it these days. So do you have any questions about that? That's the last thing I was going to talk about.
Yeah, my fingers are sore. I've been answering so many questions. And we got a ton more. Lots of people asking questions on this topic, but we're at a time and your headset's going to go. So what I would suggest for people that you didn't get your question answered, or if I didn't answer it clearly, please start a forum post or pre-submit it for next Tuesday's webinar, and we'll circle back and answer it then. Do you agree?
Yeah, I could probably dedicate time during the trade talk next week to do that. By the way, next week on that trade talk, in the afternoon at 3:30 Central, 4:30 Eastern, we're bringing Jeff Snyder back for another talk about repos. He's going to address the Q&A questions that weren't answered. I'm also on a webinar on Futures IO today with the EdgeClear team. It's our first live webcast. Again, I don't want to push my brokerage through Convergent. We want to keep things separate and Convergent agnostic, but those of you who haven't heard, that's happening today. Anyway, I apologize if I couldn't get through everything here, but time's up, and this is kind of a big topic. We'll bring it back up again. Thanks, thanks Yoda for answering all those questions and moderating. I'll catch you guys in the chat room. Take care.